In the ever-evolving landscape of finance, predicting the stock market has been a pursuit fraught with complexity and uncertainty. Stock markets are influenced by an overwhelming number of variables: company performance, geopolitical events, economic shifts, and even social media trends. Traditional methods of analyzing market data have worked to some extent, but no method can fully capture the intricacies of the stock market's unpredictable movements. However, one innovative approach is beginning to turn heads: the use of genetic algorithms. These algorithms, inspired by natural selection, are offering a new and powerful tool for predicting stock market trends. At their core, genetic algorithms, GAS, operate by mimicking the process of evolution. In nature, evolution happens through a process of natural selection, where organisms with traits that help them survive are more likely to pass on those traits to the next generation. Over generations, these traits become more pronounced, making the species better suited to its environment. In much the same way, genetic algorithms apply this concept to problem solving. A population of possible solutions is created, and over successive generations, these solutions evolve, with the best ones surviving and passing on their traits to the next generation. This iterative process continues until the algorithm arrives at an optimal or near-optimal solution to the problem at hand. In the world of finance, the problem that genetic algorithms aim to solve is predicting the often unpredictable stock market. Investors, traders, and financial institutions have long sought a reliable way to anticipate market movements. Genetic algorithms are now being employed to analyze vast amounts of market data, such as stock prices, trading volumes, economic indicators, and even social sentiment from platforms like Twitter or news articles. By doing so, they are able to identify patterns and trends that might otherwise go unnoticed, and make predictions about where the market is headed next. To better understand how genetic algorithms can predict the stock market, imagine the process as a kind of race where various potential solutions are constantly evolving to get closer and closer to predicting the future market. The algorithm starts by creating a random population of potential solutions or predictions. These initial predictions can be wildly off, much like the randomness of genetic mutations in nature. However, much like in nature, these predictions are subjected to selection based on how well they predict the market's movements. Some predictions, or solutions, will be closer to the correct answer than others. These solutions are then bred or combined with others that have also shown promise, creating new predictions that are hopefully even better than before. In this way, genetic algorithms iteratively improve, refining their solutions through a process of trial and error, just like nature's own selection process. Over time, the algorithm becomes more adept at making predictions. It can analyze thousands of variables, identify trends, and make connections between seemingly unrelated factors, all in the blink of an eye. With each iteration, The algorithm learns which patterns are most significant in predicting stock price movements and adjusts accordingly. It doesn't rely on predefined rules but rather evolves based on the data, adapting to changes in the market. Genetic algorithms are especially useful in handling the complexity of financial markets because they are designed to tackle nonlinear problems, where relationships between variables are not simple or direct. The stock market is notoriously unpredictable, with factors constantly changing and influencing one another in ways that are difficult to quantify. Traditional methods of market analysis, such as technical analysis, often rely on fixed models and assume that patterns from the past will continue into the future. However, genetic algorithms can handle the chaos and fluctuations of the market much more effectively because they are constantly evolving and adapting to new data. Another reason genetic algorithms are becoming so important in finance is their ability to process vast amounts of data quickly. The stock market generates enormous amounts of information every second, from price movements to news articles to social media posts. Traditional methods of analysis can struggle to keep up with this data, whereas genetic algorithms excel at sifting through and identifying key insights. They don't just look at past trends but also evaluate how current conditions might shape future market behavior. This ability to analyze large datasets in real time gives genetic algorithms a significant edge in predicting stock movements. The real-world applications of genetic algorithms in the stock market are already beginning to take shape. One of the primary uses of GAS is in developing trading strategies. Investors and traders can use genetic algorithms to evolve strategies that automatically adjust to changing market conditions. For example, the algorithm might start by testing various trading strategies, such as when to buy or sell certain stocks, based on historical data. Over time, the algorithm refines these strategies, learning which approaches are most successful in predicting market movements. The result is a self-improving trading system that can adapt to market changes and become increasingly effective at identifying profitable opportunities. Another key use of genetic algorithms in the stock market is portfolio optimization. By analyzing historical data, a genetic algorithm can help investors determine the best combination of stocks and assets to include in their portfolio to maximize returns for a given level of risk. Instead of relying on rigid, predefined rules, the algorithm can adjust its portfolio recommendations based on changing market conditions, optimizing for the investor's specific goals and risk tolerance. While genetic algorithms offer exciting potential, they are not without their limitations. One major challenge is that these algorithms require massive amounts of data to work effectively. The stock market is dynamic, and new data is constantly being generated. If the algorithm isn't trained on up-to-date data, its predictions may be inaccurate or irrelevant. Additionally, genetic algorithms are good at finding patterns, but they don't always understand the underlying reasons behind those patterns. For instance, the algorithm might recognize that a particular stock often rises when certain conditions are met, but it won't necessarily understand why that's happening, whether it's due to a company's earnings report, changes in market sentiment, or something else. Another challenge is that genetic algorithms can sometimes overfit to past data. Overfitting occurs when the algorithm becomes too focused on past trends and fails to generalize to new, unseen data. This can happen when the algorithm becomes too tailored to historical conditions and may struggle to adapt when those conditions change. For example, an algorithm trained during a bull market may struggle to predict outcomes in a bear market, as the dynamics are different. Despite these challenges, the use of genetic algorithms in finance is gaining momentum. They offer an innovative and dynamic approach to predicting stock market movements, continuously evolving and improving as more data is fed into them. With their ability to handle complexity and nonlinearity, genetic algorithms represent a promising tool for investors looking to navigate the often unpredictable world of finance. The application of genetic algorithms to stock market predictions is just the beginning. As technology advances and more sophisticated algorithms are developed, the potential for genetic algorithms to revolutionize financial analysis and investment strategies becomes even greater. The power of evolution, harnessed through artificial intelligence, is opening up new possibilities in a field that has long been defined by uncertainty. Whether these algorithms can fully predict the unpredictable remains to be seen, but their role in reshaping the future of finance is undeniable. So, as the world of finance continues to evolve, genetic algorithms offer an exciting glimpse into the future, where predictions are not just based on past data, but on an ever-evolving understanding of the market itself. It's a new way of thinking about finance, one where the market doesn't just move unpredictably but can be understood, refined, and, perhaps, predicted, one evolution at a time.